So let's kick off and set the stage of, what is the proof of cash? Why does it matter? So the proof of cash, also referred to as the proof of revenue or the proof of expense, looks to verify a company's revenue and or expenses by comparing them to the bank statements. So picture this, you're under LOI for a business acquisition. You have gained access to the company's accounting system, QuickBooks, for example, and they have provided a listing of the bank accounts for the business. For purposes of being simple, let's say they have one bank account for the business. Everything flows through that one individual bank account. So you've requested the last 12 months of statements. Effectively, what the proof of cash looks to do is confirm on a cash basis that the inflows um, into the bank account are being reflected and in line with how revenue is recorded in the company's accounting system. So on one hand, you have the bank statements. On the other hand, you have the accounting system and the financial reports. So you're trying to tie the two together. Um, you do that on the inflows and the outflows of the business. The outflows of the business um, are expenses. You know, bank statements sometimes look a little bit different and they use different words, but at a high level, matching the inflows to the revenues and matching the outflows to the expenses is the big picture of this analysis. So, why do we do this? I might be getting ahead of myself, but if we want to skip to the next slide, I always say when I'm asked, why do we do this test? It's to indicate, I call it the fraud check. The bank statements do not lie. It's very challenging to manipulate a bank statement. Um, if you're working with sellers who may be bad apples, hypothetically, yes, they could manipulate the bank statements before sending them to you. It's very challenging to do this correctly without being noticed. But it's in large part, the bank statements are hard to manipulate. On the flip side, it's very easy to manipulate or change certain numbers in the company's QuickBooks to paint a different picture. So for a business that is very small, $250,000 or even, a $50,000 investment, I would be doing a cash proof because this looks to ensure that there's not a material misstatement in the financial data, the revenue, expenses, and incomes of the company. Assuming this cross check is validated, you can rest assured that there's not a material misstatement in the small business or the deal you're looking to invest in or purchase. That's kind of a high level. So, what are some of the key steps to do this? First, you're going to select a period and identify, which months you're going to analyze. So today is April 2nd, 2026. If I was under LOI for a business today, at a minimum, I would conduct this analysis for all of 25. So all of 2025, the months, and then I would include the months available in 26. I would probably ask for January, February, and March. So 3 months in 2026, 12 months in 2025. So that would be the period we're going to review. Um, when we get to the example, this will make a little bit more sense, but effectively, you will plot out on an Excel sheet the various columns and begin to scan the bank statements each month and input the information presented to work through this analysis. As you work through the analysis, you're going to be inputting things into the Excel like total, debits. You're going to input total deposits and credits. And then you're going to pull in the reported revenues and expenses from the QuickBooks or the P&L statement. Uh, Things to look out for, which will impact your grid, are when you're scanning the bank statements, you want to be on the lookout for things that are non-operational in nature. So, what do I mean? What do I mean by that? If you think about your personal bank account, um, let's say hypothetically you were to transfer funds to an investment account. On the bank statements, you'll see certain dollar amounts. Let's say hypothetically you transferred out $50,000 to put into an investment account. On the bank statement, it's going to look like there's a disbursement or a withdrawal of $50,000 to, which occurred on the bank statement. Um, if you were to read the description and you were to determine that this is really a non-operating activity, like you didn't pay vendor $50,000 to do something for the business, it's just moving money around, those items should not be classified as expenses on the income statement. So I'll say that again. When you're scanning the bank statements, you want to be on the lookout for a few things that look non-operating in nature. Inflows into the bank accounts, which are from other bank accounts, so transfers, or they're from certain activities that truly aren't business related. Uh, High level, that is the thing that catches people, and people don't understand when they're doing this analysis. Um, so that is ways when you're scanning the bank statements to keep an eye on it. That's going to be done on both the inflows, so the revenues, the inflows to the banks, and then the outflows are the expenses. And you're going to do this on a month by month basis. So for those of you who may not be as familiar with the process or don't come from accounting or, you know, finance, I would say working with a CPA who specializes in M&A is helpful because they know how to do this. At a minimum, they can coach you and explain how and why they removed or included things. But that's sort of the key steps. You're going to plot out the months, select a period, and then begin opening up each bank statement and filling in the information. If you stick with me for another 5 or so minutes, we're probably going to jump into the exercise, but a few more things I wanted to get to. So, critical considerations. So, pay close attention. Common pitfalls I already addressed. It's failing to remove or pull out non-operating activity. So think things like transfers in, transfers out, bank account activity between bank accounts. Those items are simply moving cash from one account to another. They should not be recorded as revenue and expenses on a company's income statement. If you take a step back and you think about this, uh, it's a very simple thing to understand. The challenge is what I see in practice is many accountants will incorrectly record these as expenses or as revenues, which can be very impactful when you're valuing a business. Let me give you an example of something I saw recently. On a recent deal, we came across $100,000 bank transfer, which was incorrectly recorded as revenue. So on the bank account, they transferred from bank A to bank B, but the company was using a fractional CFO who wasn't very familiar. She also happened to be new, and she was simply taking all the activity in the bank accounts and she incorrectly recorded this 100K as revenue. There wasn't anything fraudulent or it wasn't intentional. It was really a clerical error. But after uncovering this, this effectively lowered revenue by $100,000. In terms of overall impact, a $100,000 deduct to EBITDA for this deal specifically was a $500,000 purchase price adjustment. The multiple being used on EBITDA was 5 times. So a very simple clerical error could have been very costly for the buyer if this was not caught. So this is why, in my opinion, the cash proof is the most important test you should and must conduct on every acquisition before you sign that purchase agreement. So best practices is going to be working with someone who knows how to conduct this process. And if you're not comfortable doing this yourself, hiring someone who can, and then picking an appropriate month period to work with. If we go back to what I just said, if I were buying a business today, I would conduct a proof of cash for at least January through December of 2025 and the months which were available in 2026, January, February, maybe even March, if the data was available. If we head to the next slide, we can keep going. So let's jump into the case study. So we're going to jump in and basically walk through how to do a proof of cash. If you have questions throughout the process, feel free to put them in the notes or raise your hand, and I'm going to get to it once I conclude. We're going to go through 2 months. Shouldn't take more than 10 minutes. Then after that, I'm happy to answer questions people might have. So let me go ahead and share my screen. All right. And if you can't see this or there's something you're having trouble with, feel free to raise your hand and I'll try to zoom in. So we're going to select 2 bank statements and do the proof of cash for 2 periods. So as I kind of alluded to, this is the proof of cash testing grid. So you're going to see that the months included for these purposes are showing January through October of 2025. And then we're going to select January and February to fill out the information. The end goal of this exercise is we want to have adjusted cash receipts per the bank be within plus or minus 1, 2, or 3% of the expected cash receipts as reported. So B, it represents the cash receipts or the revenue as reported per the company QuickBooks. A is the cash receipts per the bank statements. So that's an important thing to focus on so you understand where the inputs and outputs are going. So where do we start? If we head over to the proof of cash, I think it's best practice to open these side by side. So if we go to January, on my right is the bank account, and on my left is the grid. And it's important to do is one at a time. So we'll see that the cash receipts per the bank, and a lot of this grid has formulas in it. But starting at the top, um, you will input the deposits, withdrawals, and the checks. So if we scan the bank statements, it looks like the previous balance was 90,000, and I'm going to zoom in, 90,506. There are checks of 17,450.34. There are deposits and credits of 146,802 and 5 cents. And there are withdrawals and debits of $144,224.34. So the withdrawals and debits are the outflows. So these should be expenses. While you've populated this grid, we need to open up the bank statements and do a quick scan. So when I'm scanning the bank statements, what am I looking for? I am looking for items that appear to be non-operating in nature. Non-operating in nature or transfers, because that is going to impact whether I remove some of these items or not. So you'll see here we have a JP Morgan Chase EXT, then they use the word TRN transfer. So this is an indication that there is some sort of transfer which is included in the other debits account. So I would actually remove this amount because the company should not be recording this as an expense. Scanning the rest of the statement, there's no other things other than this that is showing up that looks potentially non-operating. You'll see that there's paycheck, there's payments to vendors, etc. There's nothing that is triggering to me anything else. So we flip over to the deposits and credits. You'll see 146,000 was the total, and I'm going to do the same exercise. So I'm going to scan and look for things that are non-operating in nature, transfers, etc. You'll see the mobile deposits don't give me much to go off of. Continuing scanning down. I don't see a lot here, but let's take a look back at the grid. So from here, we will pull down the deposits and credits, so 146,000, and then we want to identify what are the real deposits. What are the items that are truly operating in nature? That's what this looks to answer. So if we go back to our grid, something which came up in this one, which was a bit unusual, is this item right here says Vanco payment e-service check was actually returned. So the company received monies, and they actually were the customer requested a refund. So in good faith, they decided to refund the customer. And this actually came up. You'll see an exact dollar amount was debited for the exact same company. This was uncovered through our initial flagging of this, as well as confirmation by management. So what does that actually impact your deal for? This $10,000 amount, which is sitting within 146,000 of credits, needs to be reduced because it's not a real deposit and should not be recorded as revenue because it was returned. You'll see that real deposits goes from 146 to 136. If we go down, this is where this is where we pull in the information from the bank accounts, and this variance line is our check figure. So you'll see that we pulled in the cash receipts from the bank. Our adjustments for non-revenue receipts and other items was this $10,000 amount, which we just flagged. This can be things like transfers, refunds, or things that are non-operating that we wouldn't expect the company should be recording as revenue. I want you to think about that when you're making this assumption. From there, we have a total adjusted cash receipts of 136,000. So if the company was reporting on a cash basis correctly, I would expect the company to show revenues as reported for 136,000. Here's where it gets a little tricky in business acquisitions. Typically, a company is reporting on an accrual basis. So an accrual basis is a different basis, and it's not being recorded when cash comes in and cash comes out. The question I get asked is, how do we account for this in this analysis? Most of the time, if you head over to the balance sheet and you take the change in balance sheet accounts, which are non-cash, you need to adjust revenue by this amount. So when we headed over to accounts receivable, there was a change in accounts receivable of $48,388. So accounts receivable increased. And this, for the accountants out there, you will understand this. Accounts receivable increased. The other side of that entry is revenue was recorded and revenue also increased. But the only thing that did not increase was this item was a non-cash event. So the company billed accounts receivable and they recorded revenue. So this number is higher, but there was no cash activity. So nothing with this recording actually occurred on the bank statement. So if you don't take the change in accounts receivable, which is typically the only balance sheet account you need to worry about, this analysis won't match one-to-one. And effectively, you do this in order to adjust the accrual basis accounting statement to a cash basis in line with how your banks are showing it. Case in point, once you account for this, $136,004. If you compare that to your bank statement adjusted receipts, it's almost tying out with a $0 variance. Perfect. Let's move on to the next month. You're going to continue this exercise for the same months. So you're going to do February, scan the bank statements, and then you're going to move on to March, etc. So when we scan February, based on the initial review, I don't see anything that would warrant that would trigger in my mind a non-operating activity. You see here, there's deposits, there's payments, nothing here that says transfers, etc. So I would input my total number, which is the 157. We go here, that's where you're going to pull it into. You're going to add it to the grid. Based on the scan, there are no adjustments. And then we're going to take the change in the balance sheet from February compared to January. In this case, accounts receivable decreased 6,000 month to month. So once you set up these formulas, they can quickly update, etc. Case in point, this checks the box again because you are within 1%. So what happens if this is 10% or outside of the normal typical range, which are plus or minus 2 or 3%? I would recommend going back to the bank statements and making sure you have not overlooked something like a transfer or something that's non-operating. That's likely where the issue is. Other places to look if you're working with an accrual basis financial statements are heading over to the balance sheet and looking for changes in balance sheet accounts that might be non-cash related. In small business acquisitions, typically accounts receivable and accounts payable is what you're going to be dealing with most of the time. So if we look at the full grid, what is the end result going to look like? So the end result is going to show the receipts and the withdrawals month to month, and then total those year over year. So since we did receipts, there were items that were adjusted, non-receipt revenues, non-revenue receipts and other items. Most of it were transfers and then that one refund for this deal specifically. If we head over to the expense side of things, it's the exact same exercise, just using reported expenses. In this case, it was cost of goods sold and general and administrative expenses, and then taking the change in balance sheet accounts that were non-cash. Non-cash in this case was credit card activity, uh, other current liabilities, and then there was a decrease in a deposit for a service vehicle. Overall, when you're doing this month to month, after you total them each year, for expenses, rule of thumb is 5%, plus or minus is an acceptable range. And on the revenue side, I like to keep it no more than 2.5 or 3% of a variance. The risk for this exercise is that reported revenue per QuickBooks, is significantly higher than reported cash receipts per the bank statement. So I'll say that again. The risk for this one is that B, which is the expected cash receipts, is significantly higher than what is the realities. So when I see the inverse, the risk is also mitigated because you're worried about the company overstating revenues and understating expenses. Understating expenses is what we see a lot due to not reporting or misclassifying expenses. On the revenue side of things, it's typically pretty clean. Um, a copy of this grid can probably be pulled from online resources. The one we use here is for internal basis, but I may be able to share a redacted version if you'd like a copy. This type of engagement is conducted on all of our deals because this is the final check of, is there a risk for material misstatement for your deal on the receipt side or on the expenses side? So I highly recommend you conduct this or work with your DD provider to do this. So with that, I'll go ahead and pause for a couple questions. Some things came in. As you have more, feel free to throw those in the chat feature, and I'll try to get to them. So when Chris, I appreciate the question. So I think the crux of it was um, anytime there's a significant amount of transfers, this analysis becomes tricky. Um, you need to make sure that transfers are all being reflected in this grid, because if you're missing some, it's not going to work appropriately. That being said, working with your bank to get a listing of those transfers should make this exercise pretty simple if you take your time and work through this accordingly. So if we head back over to the slideshow, this was just another snapshot of, what does a proof of cash look like? What does it do, et cetera. Uh, Again, you want to start at the bank statement level and compare back to the accounting records. If you want to scan the QR code, you can receive a copy of my financial due diligence checklist. This has the latest templates we use on all of our deals. Feel free to scan this and you'll receive a QR code a little bit later today. While we're scanning, Joel, thanks for the question. I appreciate it. In terms of sales tax, you're absolutely right. It would not be recognized as reported revenue. Um, it depends on how it is flowing through the financial statements. So I would definitely want to double click and make sure you're appropriately capturing that in your grid before you start doing this sort of analysis. But thanks for the question.